let's just dive right into this morning's macro explainer. Today, we're breaking down the overnight global events and, more importantly, translating them into immediate tactical technical setups for your trading session. If you need to know exactly what's moving the markets right now and where the critical levels are, you are absolutely in the right place. We're skipping the fluff today. We've got three massive things keeping markets wide awake right now. The ongoing Hormuz drama that's fueling some serious stagflation fears, some truly wild divergence in corporate earnings alongside UK political noise, and most crucially, the technical pivot points across major assets that are literally on the verge of breaking. To set the macro stage, just look at what the IMF is saying right now. They're officially warning us about stagflation, served up with a heavy dose of geopolitics. With Iran confirming that vessels, even Chinese-owned ships, are passing through the Strait of Hormuz under Tehran's oversight, energy markets are feeling the squeeze. Brent crude is holding above $106 a barrel. This energy shock is the undeniable undercurrent beneath literally everything we're looking at today. And we are seeing that inflation reality vividly right now. India's wholesale price index unexpectedly surged to an 8.3%, 42-month high in April. Rising energy costs are feeding straight through the economy. Wholesale prices are quite literally climbing faster than your weekend grocery bills. Inflation is flat out refusing to cooperate, and bond markets are definitely feeling it. Over on Wall Street, the Dow actually reclaimed the 50,000 level, but there's a brilliant contradiction under the hood here. Cisco jumped 17% after beating estimates and raising guidance, but get this, they simultaneously announced job cuts. It perfectly captures the current market mood, right? Modern corporate optimism apparently comes with layoffs included. We also saw Nvidia gaining after reports that some Chinese firms were cleared to buy its AI chips, showing us that US-China trade dynamics are still a massive needle mover. Now, in a normal environment, some of today's impending data slate might just fly under the radar. But in this highly reactive, geopolitically charged market, no way. This barrage of second-tier data, like the ECB bulletin, U.S. industrial and empire manufacturing numbers, Canadian housing, and Russian Q1 GDP, is getting first-class attention. Traders are hunting for absolutely any signs of economic cracking. Let's transition into the technical war room, starting with the dollar index. The DXY is up for a fourth consecutive day. This strength is heavily driven by strong U.S. retail sales that matched expectations. But more importantly, it's about the politics. Kevin Warsh was just confirmed as Fed chair in a 54-45 vote. He's inheriting a committee that's moving away from cuts, right into a Hormuz-driven stagflationary storm. So because of that fundamental backdrop, the absolute magic number for the DXY today, your crucial pivot, is 99.13. Looking at the DXY setup, price action dictates we are strictly in a no-trade zone. You've got a support floor beneath you at 98.60 and resistance capping the top at 99.00. Until either that 99.13 pivot is cleared with conviction or the 98.60 support completely gives way, you sit on your hands. The market is digesting the new Fed leadership and rising U.S. yields, so just wait for the technical confirmation. Against that strong dollar backdrop, the euro is just breaking down. The EUR/USD has dropped over 1% in just 4 days. Why? Because ECB staff drastically revised their 2026 Eurozone GDP down to a measly 0.9% from their pre-war baseline, while simultaneously pushing inflation forecasts up to 2.6%. That fundamentally kills any momentum for a buy-on-dip strategy we might have favored earlier. Tactically, keep a very close eye on the 1.1630 pivot. We've got support just above it at 1.1656. Now, if that 1.1630 floor breaks, the pair officially turns into a sell-on-rise scenario. The macroeconomic divergence between the US and the Eurozone is simply too stark right now to fight the trend. Overhead resistance is sitting up at 1.1689. Now, watch what happens when domestic politics completely breaks a currency. Over in the UK, despite positive Q1 GDP growth, the headline dominating the screens is Health Secretary Wes Streeting resigning and citing no confidence in the leadership. This pushed UK 10-year yields right above 5%. Normally, higher yields attract capital, but right now, it's created a deeply toxic gilt-sterling correlation, where those higher yields are actually a huge negative signal for the pound.
With that domestic political noise completely overshadowing the economic momentum, the tactical view for cable is a definitive sell on rise. The market absolutely despises uncertainty. Look for price action to reject at the 1.3393 resistance level to initiate shorts, targeting immediate downside support down at 1.3326.
That theme of fiscal pressure extends straight into Asia, where the yen is sliding right back toward those dangerous pre-intervention zones. The main driver here is PM Takachiji's massive Senanomics fiscal package. We are talking about 21.3 trillion yen in planned spending. That threatens to widen Japan's deficit from 2.5% toward a staggering 6% of GDP. To really wrap your head around the sheer scale of this macro move, the Japanese 10-year bond yield has experienced a massive 25% up move since the war started. It's now sitting at 2.66%. The pressure on the Bank of Japan is immense right now, and the currency markets are testing their resolve every single day. Because of this extreme volatility and the looming threat of further central bank intervention, your absolute line in the sand for USD/JPY today is the pivot at 158.78. Here is your setup. We are in a strict no-trade zone. Don't try to be a hero on this one. You wait until that 158.78 pivot decisively breaks, or you wait for the pair to safely retrace down to the 157.31 support level. Anything in between is just noise and intervention risk. Bringing that risk-off sentiment into emerging markets, the currency situation in India is looking pretty grim. The rupee slipped another 0.06% to a fresh all-time low of 95.7625. It's officially Asia's worst-performing currency in 2026. The culprits? Exactly what you'd expect. Stubbornly high crude oil prices from the Middle East conflict and just relentless foreign portfolio outflows. Since the conflict began, the rupee has weakened over 6% against the dollar. From a tactical standpoint, despite hitting record lows, the overarching chart structure actually remains buy on dips for the dollar-rupee pair. You have an immediate resistance ceiling at 95.82 and a secondary level up at 96.18. If we do get a pullback, look for deeper structural support to hold right around that 95.43 mark. Yet, somehow, despite the currency woes and high inflation prints, Indian equities actually showed remarkable resilience. The Nifty 50 gained 1.18%, closing at 23,689.60, with mid-caps advancing as well. This was heavily supported by steady corporate earnings and a sudden wave of optimism around Presidents Trump and Xi actively discussing efforts to keep those oil trade routes open. However, do not let a green close fool you into complacency today. The overarching technical structure remains a sell on rise in these highly fluid times. If you're playing equities today, restrict your actions strictly to intraday trading. Watch the support bands between 23,576 and 23,439 and be ready to take profits or initiate shorts near the resistance bands between 23,819 and 23,970. That wraps up our explainer of the overnight macro landscape and the tactical setups you need for today's session. But I want to leave you with this thought. With a new Fed chair in Kevin Warsh stepping directly into a Hormuz-driven stagflationary storm, this macro environment can shift in literally minutes. Are your technical setups and your risk management agile enough to survive the very next breaking headline? Keep your eyes locked on those pivot points today, stay incredibly nimble, and above all, stay focused. Catch you next time.